What you might have seen in the headlines seemed like another typical investment story, another foreign fund setting up shop, another ribbon cut on Bay Street. But if you stop there, you're missing a much deeper shift that's happening right in front of us. This isn't just about one Australian infrastructure fund opening an office in Toronto. It's about something far bigger. The world of global capital is quietly re-ranking countries, and the factors driving that shift aren't what you might expect. Stability, predictability, and respect are now key drivers in investment decisions, and the United States is slipping down the ranks faster than most realize. I want to take a moment to walk you through this, because if you care about where long-term jobs, infrastructure, and security are heading, this matters to you directly. Let's start with the basics of what happened. A major Australian infrastructure investor opened a Toronto office, signaling plans to significantly expand in Canada. That alone is enough to make headlines, especially when the political context framed this as a subtle criticism of Washington. Many likely saw this as foreign capital fleeing U.S. uncertainty or as a win for Canada in the global diplomatic race. While that perspective isn't entirely wrong, it's also overly simplistic. It treats capital like a nervous tourist reacting to the latest headlines. In reality, though, capital moves more like a glacier, slow, deliberate, and methodical. It's not a reaction to the news cycle, it's a response to long-term trends that have shifted beneath the surface. What's being left out in most coverage is the type of investor involved here. These aren't hedge funds chasing quick returns or private equity firms seeking short-term exits. These are long-term pension-backed infrastructure investors whose very business model depends on the predictability and stability of governments. When these investors decide where to place offices, staff, and critical assets, they're making a statement. They're casting a vote of confidence in the political systems they believe will remain stable and functional over the next few decades. That's the real story here, and it's why it's so important for us to pay attention. Because the decision isn't just about one company choosing Toronto over Washington. It's about how global capital is quietly reevaluating the reliability of political systems. Now, let's zoom out and look at the broader picture. Over the past several years, the U.S. has increasingly used tariffs, trade threats, and policy unpredictability as tools to exert leverage, even against close allies. While this is often sold domestically as a sign of strength, in the world of long-term capital, it reads very differently. To those managing large sums of investment, it reads as risk, unpredictability, and a lack of trust in the system. The message is clear. Policies could change overnight based on the political mood rather than a stable, consistent process. And when that happens, capital doesn't protest. It quietly looks for safer alternatives. Meanwhile, Canada has been doing something much quieter but incredibly strategic. It has been positioning itself as a place where infrastructure investment is seen as a partnership, not a hostage negotiation. Ottawa's message has been clear and consistent. Long-term capital is welcome here, public priorities matter, and the rules won't be rewritten after every election cycle. While that might not be the most attention-grabbing message, it's exactly the kind of stability that patient long-term capital seeks. That's why this shift in investment flows is so important. Infrastructure is not an abstract concept. It's the physical foundation of modern society. It's the ports that move goods, the energy networks that power cities, and the digital systems that keep the modern world running. When global investors choose to build and own these assets in one country rather than another, they're helping to shape the economic landscape for decades. This kind of decision influences wages, tax revenue, public services, and even political influence. And this is how economic power moves in the modern world, not through speeches or political drama, but through the quiet, steady shift of capital. The point of all this is not to diminish one leader or praise another. The real issue here is that this moment reveals how capitalism enforces discipline on governments. Systems that generate chaos, unpredictability, and coercion get punished financially, not morally. On the other hand, systems that offer stability, predictability, and respect for the rules get rewarded. This isn't about ideology. It's about the way large-scale capital flows and how governments are held accountable for creating environments that either attract or repel investment. The reason this moment matters isn't about scoring political points or embarrassing one country or leader. It's about how global capital is making its choices based on long-term stability, and that has serious implications for the future. When you look at infrastructure, whether it's ports, energy systems, or digital networks, you're looking at critical investments that don't generate quick profits. These are assets that yield steady, regulated returns over decades. They require cooperation with governments, labor forces, and communities. And they need trust in the system, trust that contracts will be honored, that the rules won't change overnight based on the whims of the political moment. When that trust erodes, the response isn't immediate outrage, it's diversification. Investors start quietly spreading their capital to jurisdictions where that trust still exists, where they can count on stability, and where long-term plans won't be derailed every time the political climate shifts. And that's exactly what we're seeing right now. The U.S. has used tariffs and threats as tools for leverage, but in the long run, these tools signal instability. They make it clear that the rules can change at a moment's notice. That's a message that long-term capital doesn't respond to well. Instead, it seeks out environments where the rules are clear, where there's consistency, and where governments are predictable partners. In contrast, Canada has been sending a different message, one of stability and long-term partnership. By positioning itself as a place where infrastructure investment is seen as a long-term commitment rather than something to be manipulated for short-term political gains, Canada has created an environment where global investors feel secure. The message coming out of Ottawa has been clear. We welcome long-term capital, and we are committed to creating policies that ensure stability and continuity regardless of election cycles. This focus on stability is precisely what makes Canada an attractive option for pension-backed infrastructure investors. These investors are not speculators. They're custodians of retirement savings for millions of workers. Their mandate is not to take risks on the next big thing, but to preserve and grow value steadily, ensuring that people can retire with dignity. When these investors decide where to place their capital, they're not just thinking about economic growth in the short term. They're thinking about the long-term sustainability of the systems that will support those investments. And they've recognized that Canada's institutional environment offers the kind of stability they need to make those long-term commitments. But this isn't just a story about Canada benefiting from a moment of political uncertainty in the U.S. It's a reminder that in the world of long-term capital, political systems matter deeply. Investors are constantly assessing whether a country's political and economic systems can handle complexity and uncertainty without falling apart. When a system becomes unpredictable, when it's subject to sudden changes or erratic behavior, capital starts to look for alternatives. It's not about ideology or partisanship, it's about managing risk. For investors in long-term infrastructure, the decision isn't about which country has the most immediate economic growth or the best political sound bites. It's about which country offers a reliable and predictable environment for building critical assets that will support the economy for generations to come. In that sense, what's happening with the Australian infrastructure investor is not just a vote of confidence in Canada, but a reflection of the wider trend in global capital, where predictability and stability have become the most valuable assets. The outcome of this trend might not be immediately obvious to the public. After all, investment decisions don't make headlines in the same way political events do. But over time, it's these decisions that shape the economy. When global capital flows towards stable, predictable systems, it creates jobs, drives infrastructure development, and generates long-term economic growth. But when it flows away, the effects can be devastating. Infrastructure decays, jobs are lost, public services are cut, and over time, the entire economy suffers. What's particularly important about this shift is the type of capital we're talking about. Pension-backed infrastructure investors are not gamblers. They are not speculating on the next big tech startup or chasing short-term profits. These investors are managing vast sums of retirement savings for millions of workers. Their entire purpose is to preserve and steadily grow wealth over decades, ensuring people can retire with dignity. So when they choose where to place their capital, they're making decisions that will affect the economic landscape for generations. These decisions are not based on flashy headlines or short-term market swings. Instead, they're based on a careful evaluation of which political systems offer the best environment for long-term planning. That's why when we talk about the U.S. slipping down the list of preferred investment destinations, it's not a political judgment, it's a practical one. U.S. policies that prioritize short-term leverage, volatility, and trade threats might make a big splash in the media, but to long-term investors, they signal something much less appealing, a lack of reliability. In the world of long-term capital, consistency is king. Investors are looking for governments that won't throw the rules out the window every time a new administration takes office. They want to know that they can build and own assets in a country where the systems will still be functional 30 or 40 years from now. And this is where Canada has been able to position itself effectively. By focusing on stability and long-term partnership, Canada has created an environment where these infrastructure investors feel safe. This isn't just about theoretical investment flows either. It's about the practical realities that come with these long-term decisions. When investors commit to building and managing infrastructure in a country, they're not just placing their money on the line, they're also committing to building systems that affect people's daily lives. Infrastructure impacts how we move, how we work, and how we interact with each other. It affects our quality of life, the reliability of our services, and the opportunities available to future generations. For these investors, it's not just about the return on investment, it's about the stability of the investment environment. They want to be sure that the contracts they sign will be honored, that the rules won't change midway through the project, and that they'll have a reliable partner in government to ensure these projects are carried out properly. That's why when a country fails to provide this kind of environment, capital starts to look for alternatives. And when that capital flows away, the effects are felt by everyone. Construction jobs are lost, public services are cut, and communities suffer. We also need to recognize that infrastructure investment isn't just about the physical assets, it's about governance. The countries that attract long-term infrastructure capital are the ones that provide the kind of governance that supports these projects. A government that can plan for the long term, that can build strong partnerships with investors, and that treats infrastructure as a public good rather than a political weapon is the one that will attract the capital needed to build a thriving economy. And the opposite is also true. Countries that use infrastructure as a tool for political leverage, that change the rules on a whim, or that engage in constant threats and coercion will drive capital away. When capital flees, the consequences aren't immediately visible. Roads may still be passable, energy may still flow, but the maintenance and growth of these systems suffer. New projects are delayed or shelved, and the country starts to fall behind in the global race for economic development. Over time, this erosion becomes more obvious. Public services deteriorate, taxes rise, and wages stagnate. And when people begin to notice these issues, it's often too late to reverse the damage. The capital has already made its decision, and that decision is based on a long-term risk assessment of a country's stability, not on short-term political theatrics. That's why this moment is so revealing. It's not about who won or lost in a political sense. It's about how global capital is quietly making its judgments based on the stability and reliability of political systems. And the fact that more and more capital is flowing away from the US and toward places like Canada is a clear signal that the system is shifting. Governments that fail to recognize this shift, that prioritize short-term leverage over long-term planning, are going to find themselves on the wrong side of history. This shift in global capital is more than just a vote of confidence for Canada. It's a powerful message to the United States about the importance of stability and reliability in governance. Capital doesn't make decisions based on personality clashes or ideological differences. It doesn't care who's in charge or what political party is calling the shots. What matters to capital is whether a country's political system is predictable and functional over the long term. And increasingly, the U.S. is being seen as a place where those qualities are in short supply. The consequences of this are significant. When infrastructure investors pull their capital from a country, the effects ripple through the entire economy. The immediate impact may not be obvious. A road might still be in place, energy systems might continue to function, and people might go about their daily lives. But behind the scenes, the maintenance of these systems starts to lag. Projects that were once planned are postponed. Investments in new infrastructure dry up, and long-term growth begins to stall. The problem isn't just that the U.S. is losing investment. It's that the country's political system has become increasingly unreliable as a partner for long-term planning. This isn't about a lack of wealth or talent in the United States. It's about the erosion of trust in the country's governance. When a government is seen as unstable, when its policies can change overnight based on political whims, it becomes harder for investors to commit to long-term projects that are necessary for economic growth. And this is where Canada has an advantage. It has positioned itself as a place where infrastructure investment is treated as a partnership, not a political battleground. The message from Ottawa has been consistent. Canada is a country where long-term capital is welcome, where public priorities matter, and where the rules don't change every time there's a new election. This kind of stability is exactly what long-term investors are looking for. They want to know that their investments won't be upended by political maneuvering or sudden shifts in policy. They want to feel confident that the projects they're building today will continue to serve the public for decades to come. What's happening now is not just a matter of one company choosing Toronto over Washington. It's a reflection of a broader trend in global capital. Investors are looking for countries that offer stability, predictability, and a long-term view. The U.S., with its unpredictable trade policies, tariffs, and volatile political climate, has started to fall out of favor with these investors. In contrast, Canada's consistent message of stability and partnership is making it an increasingly attractive destination for long-term infrastructure investment. This shift in investment is not just about money moving from one country to another. It's about the kind of future that is being built in these countries. Infrastructure is not just about physical assets. It's about governance, it's about how decisions are made, and it's about the long-term impact on communities. When infrastructure is built in a country where the political system is stable and predictable, it benefits everyone. Jobs are created, public services are improved, and the economy grows. But when infrastructure is built in a country where the political system is unstable, the opposite happens. Projects are delayed, jobs are lost, and the economy suffers. The long-term effects of this shift are difficult to see right now, but they will become increasingly obvious as time goes on. As more and more capital flows towards stable, predictable countries like Canada, the gap between these countries and the U.S. will continue to grow. Countries that embrace stability and long-term planning will thrive, while those that embrace volatility and short-term thinking will find themselves left behind. The deeper implications of this shift go beyond just capital allocation. They touch on questions of power, governance, and the future of public institutions. Infrastructure investment doesn't just change the physical landscape of a country, it shapes the very fabric of its economy and society. When global capital moves toward countries with stable, predictable systems, it rewards those countries' ability to manage complexity and plan for the long term. Conversely, when capital moves away from a country, it's a clear signal that the country's governance has failed to inspire the necessary trust and confidence for long-term commitments. This shift is not just about economic efficiency. It's about creating societies where people can rely on their governments to maintain and improve the infrastructure that supports their lives. The difference between a country that invests in long-term infrastructure and one that neglects it is profound. When a country prioritizes infrastructure investment, it creates jobs, boosts local economies, and ensures that public services remain reliable and efficient. But when infrastructure is neglected, it's the ordinary people who suffer. They face crumbling roads, aging power grids, and deteriorating public services. Over time, this lack of investment erodes the quality of life and hinders economic growth. This is where the real cost of political instability becomes clear. When capital flees a country, it's not just the investors who lose out. It's the workers, the communities, and the future generations who will bear the brunt of these decisions. The loss of long-term investment leads to fewer job opportunities, lower wages, and a decline in the overall standard of living. Public services become less reliable, and the country's economic growth slows. These changes may not be immediately visible, but they build up over time, creating a future where the gap between countries with stable, predictable systems and those without continues to widen. The most striking aspect of this story is the role that public policy plays in shaping the future. Governments are not helpless in the face of capital flight. They are the architects of the environments that either attract or repel long-term investment. The choices they make today will determine the kind of economy that exists tomorrow. By prioritizing stability, predictability, and long-term planning, governments can create the conditions necessary for infrastructure investment to flourish. But when they rely on short-term strategies, threats, and volatility, they push capital toward more stable environments, leaving their own country at a disadvantage. This moment is a quiet but urgent reminder of how powerful the decisions of governments are. It's not just about who is in power or which party is winning the political battle of the day. It's about creating a system that values long-term planning and stability, one that attracts the kind of investment that drives economic growth and improves quality of life. When governments fail to recognize the importance of this, they risk losing the trust and confidence of the very capital that is needed to build the future. As you reflect on this, remember that these decisions are not just abstract, they have real-world consequences for ordinary people. When capital chooses stability over volatility, it chooses to build the future in a way that benefits everyone. And when it moves away from a country, it's the workers, the communities, and the future generations who will suffer. This is why infrastructure investment is destiny. It shapes how we live, how we work, and how we plan for the future. When that investment flows towards stable, predictable countries, it builds a better future for all. And when it flows away, the consequences are felt for generations to come.